So actually, let's start with Tropical Battery because there's some news coming from this company, Greg. They're expanding their footprint and introducing a new service called Tropical Delivery, which is an
Mhm.
EV delivery service. So just tell us about how such a move would be beneficial for the company. Why are they going in this direction?
Well, the tropical mobility I know is where they do the delivery of batteries, right? And it's about convenience. My mother used a service the other day for her vehicle, and it was very convenient, especially if you consider that your battery might die on the road and you need to get a quick replacement. Outside of that, diversifying business is important in a company like Tropical because I mean, batteries is something that you have quite a number of choices now. Persons import batteries, and Tropical isn't necessarily the cheapest or offers the best warranty. However, they do have a very strong brand. So using that brand and trying to leverage it going into a complementary business is a natural progression for them. Certainly in terms of, kind of moving away from just pure battery sales because we see more options for batteries coming in from persons that maybe just be distributing. We see a lot of batteries coming out of Korea and other Asian countries, which have pretty good performance. So it's certainly a response of Tropical to try and see if they can diversify the business in order to kind of ensure that they, if they have to lose business somewhere, they can try and pick it up elsewhere.
Is that business even on the way out? Because electric vehicles are becoming more and more popular and may end up in
Yeah.
the 20 years being the standard.
Yeah, and that's a threat for them. That's a threat, right? So they have to try and get into businesses that complement those vehicles because certainly there is, I mean, a vehicle battery is a very expensive part. When some of these batteries go bad, the vehicles basically are written off. So, it's still early days yet. We're early in the cycle of adoption, and there are a number of e-mobility companies that are coming with different products like mobile charging and all these different things. So Tropical definitely has some work to do to see how they're going to penetrate that side of the market.
Javon is pointing out that Tropical also pays consistent dividends.
Yeah. I mean, they pay dividends. They could pay more, right? They could pay a little bit more, but it is what it is. It's still a growing company and they still have to make reinvestments. So that's, of course, going to impact the company's ability to pay large dividends. But the fact that they pay is good. It means that they're keeping their shareholders in mind and distributing some of the profits when it's available.
So, Greg, coming back to you and that question from Colette about the 138 APO, we have until the 9th, I think, to participate. I think it's the
Yeah.
9th that it closes next week, Monday. Has JMB issued a position on that APO?
Not that I'm aware of. We are a selling agent. I'm not aware of our research team putting out any information. But of course, if it does come, we'll disseminate it by our usual channels. To answer the question, I mean, there have been a host of opinions on that APO, as you may have seen. A number of other brokerage houses would have issued opinions. I know Julian's house had issued a similar opinion to NCB, but there are other brokerages that they were okay in saying participate in the offer. So what it comes down to me is every investor has to know what their appetite is and if a particular investment meets their objective in terms of, is it that they're looking for capital gains, is it that they're looking for dividends, what's the risk they're looking to take, how long they want to invest for. 138 Student Living, to me, it's a real estate company, right? It's really earning off real estate based on what they provide for the University of West Indies. I would look at it more as a medium to long-term stock. So if, as I see, somebody says APOs are no, and I think we should move past that. But at the end of the day, if it does not meet an individual's requirements, then they have the ultimate decision as to whether they invest in it or not. I think that the company has expressed a lot of good and positive things that have happened in recent years. And I think looking down the road, they do have a positive future. Of course, a lot of that is contingent on a successful APO or getting additional capital to further their plans. So at the end of the day, I mean, you have to look at the risks, you have to look at what your personal objective is, and then you make a decision accordingly. So I would look at, if it were me, and I mean, I didn't know the company, I would be looking at all the data, that all the reports, comparing them to see, all right, well, does this make sense or not? And that's what I would say about the 138 APO. The second question was on iCreate, you said?
Yeah, I'm going to ask Julian to address that one. But guys, David wrote an article on this, the 138, the recommendations of the brokers. When was it published? Yesterday? No, last week from the 27th. So out of the brokers, we have QMax giving a bullish price target and recommending it. We have JN Fund Managers also recommending it to participate. We have Sagicor also recommendation participate. We have Proven Wealth recommending not to participate. So it's a do not recommend from Proven and a do not recommend from NCB. So the opinions there are split. Julian, have you had a chance to take a look at it, and what are your thoughts?
Okay, so 138 student living it's an interesting asset in that it, again, as Greg said, it offers a service that is tied to real estate. But what's different is that the bulk of the asset base is actually the contract, not the properties themselves. So the company does not carry the properties on its balance sheet. And what we found is that if you're to borrow money using an intangible asset, which is a contract, on average, using that as a part of a collateral package, your LTV, or a loan to value ratio, would be higher because banks tend to value tangible assets more than intangible assets on average. Of course, it's case dependent, but we're just talking about on average. So in a perfect world, it would have been nice if the entity actually carried the physical properties on its balance sheet, because it would have reduced borrowing costs and in turn improve the chance of paying a dividend. As we notice, during its life of listing on the exchange, or being listed on the exchange, there has only been one instance of a dividend being paid, and the company made a one-off payment for the current financial year, as at its 9 months performance, and the company effectively paid out 2/3 of the cash on its balance sheet in that one-off dividend payment. So given the fact that over the last 8 years there have been no dividends, then as at the 9 months, the company paid out 2/3 of its total cash in a one-off dividend payment. The company has negative
But they say that paying off the debt will allow them to be able to make consistent dividend payments. Does that make a difference to you in that
Yes,
assessment?
yes, but in order to frame the conversation around what the debt payments could do, we have to think about what has happened already and what is currently happening, right? Because the latest data we have is the 9 months. We actually don't have projections from the entity. We're not being guided by management as it relates to future payments. So we have to use the material facts, which are the historical financial statements and the latest statements out, and then we'll do our own projections from there. So I'm just framing the conversation, right? So if the company has about less than 30 million, I think 30 million Jamaican dollars in cash, they have working capital challenges, meaning that as at the 9 months 2023, company has negative working capital, and 20% of the company's receivables are not collectible, meaning that if the company is owed $5, it can only collect $4. I don't think the argument for a dividend is very strong, because dividends can't be paid from money that's not collected. So the company needs to correct its collection challenges. It needs to sort out the working capital issues, and then we can talk about dividends. So just from a risk standpoint, I think the risks outweigh the promises, I suppose. I mean, it's very hard to look at a company that would be a credit risk to then make an argument for a dividend argument, because remember, on the P&L, you have to pay your debts comfortably before you can start talking about dividends. And if it is that you're having receivables challenges and working capital challenges, then you're likely to have challenges around paying your debt. And as we know in the capital structure, the debt holders get paid before the equity holders. So if it is that the company is at risk of paying its debt, then it's likely to be at risk of paying its dividends. Okay, we'll cut the debt in half. Um, does that totally change the story? Again, the properties are not carried on the balance sheet. I mean, that's not very comforting. I like companies that print money, and 138 doesn't print money, so I'm not convinced by the dividend story.